Stocks followed an interesting pattern today, gapping down below yesterday's low point, retesting early yesterday's low point as a high, making a low again, a lower low again, and then finishing at the high of the day. So kind of a roller coaster ride up and down. For small cap stocks, we were never able to get back up above yesterday's low. So which may be a little bit of a precursor of what we can expect to see in the next couple of days. So I'm going to talk about that. And whether or not that's going to be just noise or if that's the start of a longer pullback, and whether the next pullback is anything to worry about. So I'm going to break all that down from a technical perspective. And then we're going to take a look at what's driving this price action, the big move we're seeing in commodities, how big that move is and what that means, and whether or not we might just be scratching the surface on the outperformance of commodities over equities going forward from here, and whether what that might mean for the markets as a whole. We're also going to talk about the types of bullish trades you can make in a market where you're on a mature bullish run and you're not quite sure about how much bullish move we have left. So we're going to take a look at the types of directional trades that we can add to all these non-directional trades we've been doing in recent videos to try to take advantage. So let's go ahead and get started. Today is Wednesday, February the 17th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the move that we had today coming off of the overbought cluster on Thursday, and then the move up, on Friday, and then yesterday's move, and then today starting down, finishing higher than the open, as you'll see on the intraday chart, finishing at the high of the day, but after coming down early to the low. So you can see the near-term line rolled over. We have lower highs in the near-term line with the dip in between. We have higher highs that corresponding or higher highs. So that is the definition of a near-term divergence. The dip in between here is right about at these lows, and so from last week. So if we were to break those lows, then we would start maybe more of an intermediate type move, at least a test of that 23% level where an intermediate trend would develop. And so as of right now, we're holding that. We'll see how we go into the next couple of days on the S&P 500 and on stocks in general. But that's the near-term divergence that's coming out of the cluster that we had. Now, the S&P was the only one to get a cluster. The other indexes, the Dow, is just grinding up and setting up for a cluster, but hasn't rolled over on the near-term line like the S&P. The Nasdaq's near-term line actually did drop close to the 50% mark. Very good chance that, barring any significant change, barring that, you can see that that would cause it more of a, that's where your near-term line would come down. But you notice that also the low point of this in between these two highs down here would correspond to the low on the 10th. So that would be last Wednesday. If we get below that low, then now we're changing things. Right now there's a good chance that we start to break the trend and may lead to a break of that 23% retracement level. But until then, we're actually still okay. And then finally, the Russell 2000, the near-term line did drop. It did not form a divergence because we never did get a new high point. We are rolling over, but again, not breaking the 30-day moving average, not breaking the 23% retracement level, and really not getting to any oversold levels yet. It's been a couple of times the near-term line has gotten below 20, and you can see the weakness that produced that. Other than that, I mean, look at this whole intermediate rally. Look, it's been pretty much all up. That little weakness in between, up. And then this one, just big, strong move here in about a matter of 6 days, kind of a parabolic move to the upside, and then nothing since. In fact, we've been kind of grinding down on the near-term line since then, with the intermediate line trying to figure itself out here as well. So, but that's a little bit of a concern, especially on the NASDAQ as well, considering that it is a lot closer to dropping below 50. So let's keep an eye on that heading into the last 2 days of this week to see if we get some more weakness, I mean, not a lot more, right? We don't have to like break the bank here. But if we were to break through these lows from last week, like I said, last Wednesday, last Thursday, really through last Wednesday's low, then that will confirm the reversal of the near-term revergence for both the S&P and the NASDAQ. Until then, again, that's a target for the first target for the near-term divergence, and that can hold for support at a very short-term level, and we can bounce right off of that and continue higher. And considering the strong trends we're on right now, very likely something like that's the case. So again, very key level to watch for into the end of this week is the low points on from last Wednesday for both the S&P and the NASDAQ 100. And the Russell might be telling us, since we are below last Wednesday's low the Russell might be telling us to expect that going into the end of the week. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know two things. You liked our video today, and you want us to do another video again tomorrow. So quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, you can do that with one click. You can do that right now while you're watching. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions do you have? What comments do you have on anything I talked about in the video? Post those down in the comment section. Join our website for free at marketscholars.com. There's a link popping out there in the top right corner of your screen that will take you to our site. One of the things you get on our site for free is access to our Market Outlook forum, our message board where all other market scholars and you can interact with others over what we cover in these videos. Also, follow me for more content in between the videos on Twitter. There's my hand right there at DavidSettle42, and then join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out some of these things over here on the right, including our class schedule that we have coming up, as well as our Market Outlook live video where I review all the trade ideas that I do in my Market Outlook videos. We continue to trade them until we close them, and so we talk about how to manage all those trades. It's one thing to put them on like we do in these videos, but it's another thing to continue to manage them. As you can see here, all of our monthly subscribers get access to all 8 of our trading rooms and the 3 Market Outlook live videos that we do on Monday, Wednesdays, and Fridays. You can get access to that monthly plan by clicking on that link or coming up here to our Plus subscription. Our Q&A sessions, as well as our class forums and our premium tools, are all available for our premium subscribers. And that's what we have coming up here. Brandon's is tomorrow morning, and mine's on Saturday. Come over here, click on this heart. It opens up a new window. Hit that like button. Also, come over here and click on this thumbs up. It opens up another new tab. Click that like button there as well. Again, the more you do that, it benefits us because our content will be reached by more people who follow us. More people will see our content at more than just 102. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching. Alright, now let's get back to the charts here, and let's take a look at how this week is going so far on the weekly candle. So we talked about how bullish of a candle we'd be getting here on the S&P this week, following up a very strong bullish candle last week. Well, now keep in mind that, again, going into the last 2 days of this week, next week's candle will open up right around 38.92. We're trading at 39.31. So if there is any kind of weakness in the next couple of days, kind of keep an eye on that level, 38.92, so we can see what kind of candle we'll start off next week with. As we saw, after you had a couple transition candles, we had a couple kind of more bullish candles, one really good bullish, and then kind of another, and then we rolled over. Well, it's the same thing happening here. We got a good strong bullish candle closing above those highs, higher high, higher close, way significantly higher close, but now just a slightly higher high, a slightly higher close, a much smaller body. Again, very similar type of setup here. And again, I'm not expecting that kind of 4-week, 5-week drop, hardly at all, right? But you can kind of see, when you get these divergent high points, what they look like on the Haken-Yashi candle. Let's take a look at the 3 green arrows. For SPY, you can see we still have 3 green arrows, so we're getting really close to a red arrow on the 2-line version of the MACD, and we're close to crossing. The moving average is pretty high, so we're close to crossing above that. You can see we're still above the 8-day moving average. That's why we haven't crossed. The stochastics has crossed below its %K, which is at its highest level that it's been since back over here in September of 2020, and that's when things kind of that's when we ultimately peaked there, broke below the 8-day, broke below 17, and then stayed down there, and that started the intermediate decline there. So kind of keep that in mind. Obviously, when you look at like the directional movement index, we're not above 30, we're not below 20 on the negative. We're just kind of, the ADX is plummeting as we're not really going anywhere. We're not getting a directional move at all. Whoops, sorry, this one. The Ichimoku cloud, we're still easily above the cloud, easily above both the green and the blue lines. The red lines easily above the price. We are making our way up to what could be a moderate trend, though we're not quite there yet. Still kind of a weak bullish trend, at least on the trend quality indicator. But as we saw again going into the COVID time frame, it's a very similar type of pattern where we went kind of bullish here, very similar. In fact, it almost looks exactly the same, where you stopped a very strong trend, you got back up to a weak, almost moderate trend strength before things turned south. It's a very same, almost exact same pattern developing here, and then you can also see too on the Bollinger Bands, we're still in the upper quartile, so that's why we're not like bearish yet. But let's watch to see if we break down into the slower half, or this middle 2 quartiles, if not below the 50% mark, which is what you start looking for an intermediate pullback. So I've told you before that was about as close as we got to an intermediate pullback without actually getting one. You can see that visually here. We dropped below 50. We even dropped into the lower quartile and then bounced right back up. And so we kind of avoided it there, but that's the kind of pattern you look for to see when one might start again. And of course, when you look at like these Fibonacci retracements in here, let me get rid of the probability of expiring cone. But if you look at these retracement levels and you say, okay, let's activate that and move it up to the high. And move this long-term one up to the high as well. Oh. Yeah. Okay, so you can see where the 38% Fibonacci retracement of the intermediate pullback is at the top of the value area. But if you break that, then it's a pretty decent drop, volume gap, until you get to the point of control at 340, right where that 78% retracement level is. So it's not going to be easy to start an intermediate pullback, but once we do, it'll be easy to kind of test these Fibonacci support levels that we've been looking at here recently. All right, so let's take a look at the intraday chart, and you can see where that you can see how, again, if we do get a couple days of weakness here, that's where it's going to be. It's going to be breaking through this 389 down to 385, if not the 382, which is not very far on SPY, but it's a lot further on IWM, right? So you notice we did not get above yesterday's low on IWM. We barely reached last week's low point. We filled in that gap from last week with today's move. We've got some more gaps to fill down here until we get to 215. So that's the area we might get down to in the next couple of days if we continue with this weakness. So kind of keep an eye on those levels. Again, that's not very big of a move. In fact, from yesterday's open to today's low, that's about an $8 move. Well, that's what we have here from 224 down to this 215. That's about an $8 move, $9 move. So it's not that big of a deal. So it's that happened over just a little bit more than a day, and so you can see 2 days. That wouldn't be that big of a breakdown, and it wouldn't even be breaking 23%. It would still just be noise. But there's very little support keeping that noise from happening on an intraday basis. If you look at the volatility index, you can see we're really still extremely low, even with the jump up in the last last couple of days, from being below 20, which, last Friday it was all that hubbub about breaking 20. It's like, come on, like you're not going to be able to sustain that breakdown with this ratio chart down at 75%. That's being below 80% is extreme. Being at 75 or lower is like insanely extreme. So that was just kind of a headline. That little touch right there, 19.98, was basically just a technical driven, headline driven, just getting below 20 so people could talk about it really. Because now you notice we're right back up to where we were last week. But still at extremely low levels, which means it's going to be very hard for this to go down on the absolute basis, because on a relative basis it's already so extremely low, which means, over the next couple of days, just to get to 85% would be a jump in volatility, probably up to about 24, 25, which again would coincide with a noisy move, a near-term pullback, a noisy move, not an intermediate, but just a noisy near-term pullback. And when your noisy moves are getting up to 24 or 25 on the VIX, then, we still, as extreme as the bullish sentiment is right now, there's still a lot of concern. As much call buying as there's still a lot of put buying from others who are thinking there might be a little something to this extreme sentiment. Let's take a look at today's volume and range. Volume 52 million. The range really, really light. So when you look at the close yesterday, the close yesterday 392.30, the high today 392.66. So no gap, but a 3.33 3-point range, 3 to third point range. So when you put those in context, you're below 1%. So we're threatening with that really low 1% level again. Again, breaking below 1% there would be the equivalent of breaking below 20 in the VIX. So if we're not going to be breaking below 20 in the VIX anytime soon, that means this 1% is going to be acting as a support level, and we're getting there again. That's kind of how extreme the ATR is dropping, and of course the volume you can see is dropping down to relatively low levels too. The money flow, if you look at the money flow, which incorporates the volume and the volume here and the price. So here's the money flow index, as I mentioned before, so it incorporates the price and the volume. As we get to higher price levels versus the volume, say, down where the price was lower here. So when you look at that, you can see how we're actually, as we go up to a higher high, we're actually forming a lower high on the. So we didn't do that here in September when we peaked. We September with the highest high point on the money flow. So we really hit an extreme. So we kind of went parabolic there. But that wasn't the case heading into COVID. Again, looking at that kind of divergent high point, you can see after getting a really strong level here, kind of volume, then we really went downhill with lower highs as we continue to grind higher. So again, very similar to what we're seeing here, and may lead to, especially when we drop back, that now that we're above 70, we're overbought in the volume. Once we drop back down below 70 from a divergent high point, again, that may kick off that period of weakness that we may be looking for here. So to summarize, our technical outlook before we talk about what's driving the price action today. Again, strongly bullish, some weakness showing up in the last couple of days. Could be more weakness. In fact, kind of leaning towards we might see some more weakness, especially in small caps over the next couple of days. Nothing trend changing, nothing even signifying that we're starting an intermediate pullback, but just kind of a noisy move because of how strong the rally was, especially in small caps. And then we've gone sideways and we're starting to tilt to the downside, breaking down a little bit in that Russell 2000, which may be a precursor of what we're seeing elsewhere, especially with divergences setting up on this last near-term, higher near-term high, with a lot of other oscillators that are showing lower highs, lower corresponding highs, suggests that we may be headed for another noisy period. The noisy pullbacks are going to get more frequent as we have mature intermediate rallies. So we've had one, we've had a good near-term run since, and now it looks like we're mature even in that. and we may be headed towards another noisy period into options expiration this Friday, and then coming out of that. Whether or not we actually start an intermediate pullback, probably not the case. But it doesn't mean that we either go up or we tank, right? It's it's an up and a down, and I think we'll get a noisy period of pullback, but not enough to start an intermediate trend. We go back up with more frequent ups and downs on the near-term line before we finally, as we head into March expiration, start some kind of exhale on a deeper and longer level. Again, not as deep as COVID, it will be a year from now, you won't even think about this next exhale. But for a lot of people who are, really piling in the bullish trades now, over the last month or so, then, that's going to be very painful. For most market scholars who, as you've been watching these videos and our classes, who have been kind of more neutral and dialing back that risk, still making trades, more time-based trades like you've been seeing in our market outlook videos, you'll be just fine, right? Because we're not really aggressively bullish at all. But we're still bullish in some trades, but not in all of our trades, and so it won't be that big of a deal. So what do you think? Do you agree with that? Do you disagree? Comment down below, especially if you disagree, and let me know what you're looking at that suggests why you're either a lot more bullish than I am or a lot more bearish than I am. All right, well, let's take a look now at what's driving the price action today. So let's look at the major asset class comparisons, and let's just look at the last couple of days here this week. So we'll go to the beginning of this week, which is actually a Monday, so we'll come here and then go to yesterday. And so look at the last couple of days and just how things are performing. Again, gold, the dollar is up, as you'll see here in just a second. Gold is down with that strength in the dollar, so not surprising there. Commodities, though, despite the strength in the dollar, commodities are doing very well. That's really helped push emerging markets up, even if stocks in the U.S. are down. You notice small cap stocks are way down, so that's really having an influence on this indicator here, this ratio chart between the Qs and IWM actually. And let's go back to a daily chart here. Daily chart, and then let's go to a smaller time frame on this. So we'll go to 50 or longer time frame, a daily time frame. All right, so here is, and here let's go to a year chart so we can zoom in a little bit. That's our chart. We're back up to the 17-day moving exponential moving average on the relative strength line. You can see the MACD is forming higher lows with the lower lows there. The CCI is forming higher lows with the lower lows there. The RSI is forming higher lows, and they're all rallying. We're rallying to where we're not bearish anymore. We're not really necessarily rallying to where we're bullish yet. So we need to get above zero. We need to get above zero here, ideally up above 50. But get above zero on the MACD, get up above 50 here, and ideally up above 60. But at least get up above 50, and then getting above the 30-day moving average. That will help kind of really change. But remember, as this changes to more of a bullish trend, a daily trend, that's typically going to be with a bull because of the trend that we had going on during this intermediate run, where small caps have led pretty much this entire intermediate run since the October low point, the Halloween low point. So when the intermediate run, when this changes, that will most likely end the intermediate run that was fueled by small caps outperformance. I mentioned in a tweet that currency markets don't get so bought into this buy the dip mentality. I'll come back to Tyson Foods here in just a minute. And you notice with the dollar yesterday, the euro really rolled over, and which means the dollar rallied, which means we're still on this pullback, this intermediate pullback on the euro US dollar. So strength in the dollar. That's a risk off move, considering the correlation that has, as I showed in my class today, the correlation between this currency pair and the S&P 500 has been pretty strongly positive for so long. Well, that correlation broke here in the last couple of weeks, and that means that something's afoot, right? A change is afoot as a relationship has changed. So I expect over the last few weeks, there's been a risk-off move in the currency world. I expect that will eventually bleed over to a risk-off move in the equity world. You can see right now bonds are dropping still, but at such extreme lows, you would expect there's going to be an opportunity for us to come off of this kind of divergent low point there and start working our way higher. If you take a look at like the directional movement index, we have gotten pretty darn extreme. The negative got all the way up here to above 40. You can see we've done this before, where we've gotten above 40 and below 10. In fact, we almost got below 10 on this. When we were below 10 on the positive index before over here, but not as high in the negative, and so we didn't really pop back up like we did there in June. So when the small cap index kind of went parabolic there in June, and then we had the month of June and into July where small caps lagged behind and bonds took off. Well, we're kind of seeing a very similar kind of parabolic move in bonds to the downside, with a sharp gap here with a very high ADX. In fact, that's the highest ADX that we've seen in the past since that bullish move, since the COVID rally. You go back just a few years for some context, and you can see again where my horizontal line, if you follow over, that ADX has been higher during bullish move, bullish move, bullish move, bullish move. We haven't had an ADX. This was the last time the ADX has been this high on a bearish move, and you can see the positive got relatively low compared to where we're at right now. The negative got really high. We had this was October of 2018. We had about another month of that before bonds really kind of took off, and you remember that was a period of risk-off moves in the S&P that fourth quarter of 2018. So keep that in mind as we approach this 50% retracement and some support. If you look at the Bollinger Bands for TLT, and let's go back to a few years. Let's go back to a couple of years here. So as we head into this area, there's a decently strong volume node. We are in the value area the last couple of years with the volume node, the point of control, way up here at the top, which can act as a pull to the upside. Though I think that the most we'll go up to is probably this 158 level. I don't think we'll get too far past that 23% retracement level, but that's the kind of move I expect to see on any kind of risk aversion that we may have. We also mentioned commodities, and they've continued to be strong, and they've really gone parabolic. You notice they have breached the pre-COVID highs. They have breached the last 2 years highs and really kind of broken through the value area of the last couple of years, and was well above the value area of the last year. So very significant breakout type move with a very high bandwidth. But then you look at its directional movement index as well, and you can see that ADX is again about as high as it gets. Very, very low negative index, very high positive index, a cluster that we saw yesterday. And then you look at the RSI and the CCI for the same ETF. You see the very extreme move higher in the RSI, and then the divergence already setting up on the CCI. And if you look at the same indicators on the weekly chart, again you can see the extreme nature. Like again on the weekly chart, very, very extreme on the RSI, and the divergence setting up on a weekly chart too. Suggests kind of keep an eye. It doesn't mean we have to fall next week, but it just means that that's a very extreme move that it's going to be hard not to come back down a little bit. If you look, let's go long term, and you can see just because we are over long in the tooth in the intermediate term doesn't mean from a long term level we still have a long ways to go before we get long in the tooth. So the commodity cycle peaked there in 2008. It's been a laggard ever since, but we are seeing signs that it's bound to change that relationship, where commodities will start to outpace equities going forward from here. You can see, look at that ratio really taken off to the upside, and MACD is strongly positive. The long-term PPO is almost positive itself. There's the CCI, there's the RSI. If I switch this to a weekly chart and then go out to say, let's go out 20 years on this. 20 years, and then let's change this back to a weekly PPO. Then you can see how the RSI is getting above 60 for the first time in a while. The PPO has gotten positive on the weekly chart on the 5200-day moving average. You can see the MACD is turning, or the PPO is almost positive. The MACD is positive with a very strong histogram, and then you can see the CCI has gotten really strong too, suggesting a strong bullish move is beginning. And there's a long run to go here as commodities peaked in 2008. So when you look at this and you look at this, then you say, okay, commodities might be overbought in the intermediate term, but in the long term, this is really going to be beneficial, especially for like emerging market stocks and other areas that are closely tied to the price of commodities, as those prices, as we've seen with energy this winter, this week, really start to take off to the upside. So it shouldn't be surprising to see energy doing very, very well. And then with the weakness in bonds, shouldn't be surprising to see financials doing very well. So those two stocks, even with the broad market flat, 2%, 4% in those areas. But those aren't really your market leading areas. So it's a little concerning that that's been so bullish and nothing else has been. In fact, our biggest sector in the S&P 500 has been really lagging behind. And it's not too often that real estate and utilities, it is common to see those two on the opposite side of financials, but not too common to see them on the same side as technology. So you can see how the strength or the weakness in these areas, if the market's going to be weak, it's going to be weak led down by this technology area, which you can see has had the more bearish candle in addition to industrials, whereas energy is still pretty strongly positive. You got a cluster there on real estate. Utilities is turning down. These are all reflective of where bonds are, staples as well to a degree. But you can see how, not as strong. The discretionary is down to its moving average. It actually has light pink shading. Communication services is strong. Technology, not so much. Industrials, not so much. Financial, still pretty strong. Materials, not so much. Energy, still pretty strong. Healthcare, not so much. So we're not seeing the broad strength across the board here. All right, so that takes us to our trade idea of the day. And as I mentioned, the market posture is still bullish, even if we're not necessarily too sold on the extent or how much more opportunity we have to the upside. But it doesn't mean that we can't do some bullish trades. And as I said before, and so this is the type of bullish trade that you can do. We've been doing a lot of iron condors to show you the type. That's pretty much the predominant trade that's applicable right now in this market environment. But if you're going to do directional trades, then you see this kind of stock where it's been kind of up and down. It's been down recently, now bouncing back up. You can see getting back above its 8-day and 17-day moving average, closing above these highs, starting to fill in that gap that we had on the earnings. You can see from a Bollinger Band standpoint, it is bouncing back after hitting the point of control, bouncing back outside of the value area with very little volume resistance up above where you're at. The directional movement index showing a change back to the upside on the negative or positive, with the negative falling back below 25. The RSI shows a move back to bullish territory, back above 0, back above 50, working our way back up to the upside as well. And then finally, if you look at the long-term big picture view, we got the golden cross going on, and we're flirting with that 200-day moving average, and now looking to make another run to the upside there. But not a strong directional pattern that you see, but directional enough that we can say, well, let's take a look at its options and see if we might sell that 65 option at the mid 30s on the delta and buy the 62.5 for for protection. You can see that's what we did here during our Market Outlook Live session. So this is we have an iron condor on it from a class trade that we've done, but there's the trade that expires this week. There's a trade that we just did today. Looks like we got 67 cents on that one. There's our break even, position size full for about $335 of gain on that roughly a little less than $1,000 of risk. So that break even is actually right here. So after gapping down the earnings and holding, we bounced back into that gap. So if we were to reverse that and make our way back down below this support level, where remember the point of control on the daily chart is like right here. So if we were to break that, then that's where our break even is, and that's when we start to look, saying, okay, we might want to close out that trade, and the bounce is not going to play out and fill in the rest of the gap and stay up here. So that's kind of a thought of the type of bullish trade that you can be doing in this type of environment. Alright, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link to go to our Market Outlook forums, the ones I told you about before, that all of our subscribers, even our free subscribers, have access to. Open up any new thread, reply to anybody else's thread, and let's keep this conversation going about what we cover here or anything else that pertains to it between our community there. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as like us on Twitter and Facebook too, and then comment on our video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.